Welcome and good afternoon, everyone, to the Tax Expenditure Review Commission meeting. Today is Wednesday, December 10, 2025. I am here along with Representative Robbins and Commissioner Marquardt attending in person, and we have a couple of members attending remotely. I believe Representative Greg Davids and Senator Bill Weber are both online. And as other members come through, we will introduce them. We are in Capitol Room G3, and we have other members that will come on shortly, hopefully. Ms. Schnabel, will you please take the roll?
Representative Agbaje.
Present.
Agbaje present. Representative Davids.
Present.
Davids present. Senator Clark. Senator Klein excused. Senator Curran. Commissioner Marquardt.
Present.
Marquardt present. Representative Robbins. Robbins present. Representative Smith.
Present.
Smith present. Senator Weber.
Present.
Weber present. Senator Clark. Senator Curran. Madam Chair, we have a quorum.
Thank you, Ms. Schnabel. We have a quorum present, and our first order of business is to review and approve the November 5th, 2025 minutes. So that should be before you in your folders, members. So if there are any corrections or any questions, I would entertain a motion to take the minutes.
So moved.
All right, moved. All in favor? Say aye.
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 All opposed? All right, and the minutes are approved. Okay, so our next major order of business for this meeting is the tax expenditure evaluation fillable template. So it's the template that we talked about at the last meeting that we wanted to put together that would help us go through the evaluation of each of the expenditures that we've heard about and how we would like to move forward with them. And so this follows up on the previous TERC discussions that we've had. So we can go through this and to decide if this is how we want to move forward on whether we keep a tax expenditure or we modify a tax expenditure or we repeal a tax expenditure. So it's before you in your folders. I believe everyone should have it or should have access to it. Please let me know if folks don't, and we can just kind of walk through it, have a discussion, and then move forward with the vote. Everyone has it? Okay. So the Minnesota template for evaluating tax expenditures, as our staff helpfully created for us, it would start with, and I think this top section would probably be filled out a little bit by the LBO, just so that way everyone is on the same page. So you would see a name of the expenditure, the year that expenditure was adopted, the estimated annual revenue lost, and any sunset date that expenditure would have. The LBO would then let us know if it's an individual income tax or a corporate franchise tax or et cetera. There's a number of options there. And they would also let us know if the expenditure is a result of state conformity to a federal code, which is also helpful to know kind of how we would want to move forward with such an expenditure. Moving on from there, this is where we as the commission members would start to fill it out, is we review the approved objective of the expenditure. So that's something that we've already decided as we go through each expenditure. The LBO already gives that to us in their preliminary review, and we decide that that is the objective that we want. And so that has already been done for a number of the expenditure reviews that we've heard already. So we have that in there. Then we check to make sure that it's actually meeting that objective. So whether it's a job creation or an investment or strategic or competitiveness in the business sector, or if it's based on individuals, is there a relief of poverty objective attached to it, progressivity or assistance to low earners, or access to opportunity or more, and or another objective too that isn't listed in the main areas. So we would all check to see if that objective, based on the review that we've heard from the LBO staff, is actually meeting that objective. On the back side of this form, we would see a section that talks about measurement and effectiveness ratings. And so here is where we as commission members would then get to decide is that expenditure actually meeting some of these stated objectives? So here is a sample of stated objectives. We based a lot of this, as we talked about at the last meeting, on the Massachusetts form. As I want to note, since Minnesota is developing our own, this is kind of just a list for us to get started. If we find in the future that this list isn't helping us really evaluate those tax expenditures, we can of course come back and update and edit this form. But this is where we wanted to start for now, as that seemed to be a basic area where folks can start to decide if this expenditure is actually meeting the objectives that we want. So some of the statements that we would either disagree or either strongly or somewhat disagree with, or somewhat or strongly agree with, would be whether is the overall benefit achieving the objective of the expenditure, whether the expenditure's benefit justifies its cost, whether the expenditure is claimed by the intended beneficiaries, whether the expenditure is claimed by a broad group of taxpayers, helpfully to measure like how widely it's being used, whether the expenditure amount claimed per taxpayer is meaningful as an incentive or a benefit, and whether the expenditure is relevant today. There's also a question that would specifically relate to business types of expenditures. So is it beneficial to smaller businesses? And then for individuals, is it beneficial to lower income taxpayers? So this would help us, this would be what then the LBO would help us aggregate from each of the individual forms to then kind of come up with a aggregate score, so to speak. And then from that score, we would then take a public vote on it. Finally, just the remainder of the form that we would be using. Each commission member can then say if they want to continue with this tax expenditure, repeal it, or modify it. And then there's a space for comments to kind of highlight maybe why you chose what you chose. Again, we want to reiterate that this form itself, the individual ones, will be private, but the aggregated form and the aggregated report will be public. So people will be able to see how kind of the commission is either coalescing or not coalescing around an idea for an expenditure. When we have the public discussion, that's when members can then kind of talk more thoroughly about what they're seeing in the aggregate report, as well as maybe how they would like to move forward with an expenditure. Any questions before I move on to the next? Yes, Representative Robbins.
Thank you, Madam Chair. I just wanted to confirm, based on our conversation last meeting, that when we turn in these forms, we turn them into your staff, we turn them into the LBO. And
LBO staff.
LBO, and then they are kept confidential from our individual comments. But when the report is back to us as members, do we see just like these forms without names attached, or how do we review what was submitted?
It'll be an aggregated report, so they'll take everyone's form. So kind of this section here that I just went through where everyone says they either strongly or somewhat disagree or agree with each statement. There'll be scores. So it'll be like, 4 of the 9 members said that they strongly disagree with this form, or 5 of the 9 members say they strongly agree. So we'll see something like that.
Thank you.
Any other questions? Okay. This next sheet attached to it is the procedures of the Tax Expenditure Review Commission. So kind of what I went through a little bit, but it talks about where our authority comes from the Minnesota statute, section 3.8855, and then the following procedures to kind of go through the evaluation cycle. So after each evaluation presentation, we'll receive this form, the evaluation fillable form that we went through, and that form will be distributed on the same day or as soon as we can from the evaluation that we heard. We're sort of a little bit behind already, but we'll catch up. But ideally, so on a day like today, we're going to hear a review of a set of expenditures. And so we'll get a form today, I believe. And then we will have a week to fill that out and return that to LBO staff. So LBO staff will be the one aggregating this for us, collecting the data for us. So that'll be on us as commissioners to make sure that we're doing our homework in that time frame. So that way the LBO staff has what they need to help us move forward with deciding what we want to do with each expenditure. as we just discussed, the LBO staff will compile and aggregate the responses from each of the TERC members, and that will be in a report that will be added to the evaluation. And it will be at then the subsequent meeting of when we heard the full evaluation and after we finished our forms, that will then have a conversation about that expenditure and then have a public vote on whether we want to continue with it, modify it, or repeal it. And all of that will then be included in the next TERC annual report. All right. Any other questions, comments, desires for change? Yes, Commissioner Markwart.
Thank you, Madam Chair. So I like this process. I mean, it's a process that I think for members will be consistent. At least you're kind of looking at the same things as you kind of move on. And I think also this form kind of sets a foundation for the discussions that will ensue. So I think it gets a little deeper than just someone saying, oh, I don't like this or I like it. You know, it actually kind of looks at objectively some things, even though we know it's subjective, but at least you have some criteria in which to really look at evaluating things. So I do think, because this is a pretty big responsibility. In fact, it's probably by far the biggest responsibility of this commission is to make recommendations on these tax expenditures. So to have a consistent laid out plan, I think is really crucial and will add to the credibility, integrity of the decisions that ultimately are made and then forwarded to the legislature. So looks good to me. Thanks for all the work on that.
Thank you, Commissioner Markwart. Representative Greg Davids, your hand is.
Thank you very much, Madam Chair, and I agree with the commissioner, and I really appreciate the way you went through this, and I think we're starting with a very good process here, and I think it'll work, but like you said, if it doesn't, we can come back and modify it, so I think it looks good.
Thank you, Co-Chair Davids. Anyone else who's online or in the room? All right. Seeing no further comments, again, thank you members for your time and input into building out what we can use to begin to evaluate this process that we are charged with as commission members. And so the next order of business will be we're voting on this, correct? Yes, okay. So then we will vote on this, and Representative Robbins, if I could have you put forward the motion for the evaluation expenditure review procedure.
Thank you, Madam Chair. I move to adopt the draft 2025 Tax Expenditure Review Commission Evaluation Process Form and corresponding procedures as presented to the Commission for consideration on December 12th, 2025, 10th, 2025, subject to technical and conforming changes adopted by the co-chairs and vice chair, received by December 19th, 2025, in accordance with Minnesota Statute 3.8855.
Thank you, Representative Robbins. Are there any other additional comments or questions on the motion? All right, seeing none, Ms. Schnabel, please take the roll.
Representative Agbaje.
Yes.
Agbaje votes aye. Representative Davids.
Yes.
Davids votes aye. Senator Clark.
Aye.
Clark votes aye. Senator Klein excused. Senator Karan excused. Commissioner Markwart.
Aye.
Markwart votes aye. Representative Robbins.
Aye.
Robbins votes aye. Representative Smith.
Aye.
Smith votes aye. Senator Weber.
Aye.
Weber votes aye. 7 ayes, 2 excused.
Thank you, Ms. Schnabel. With 7 ayes and 0 nays and 2 excused, the motion prevails. Thank you. We now have our process. So with that, the next order of business is a presentation by the Legislative Budget Office on their evaluation of the credit for small brewers, small wineries, and micro distilleries tax expenditures. And we will have Jordan Peoples and Vlad Fluvermanad, hope I got that right, to present that. So with that, I'll turn it over to the LBO to begin their presentation. Please state your name and title for the record, and then you may begin.
Slides.
Yeah. Please go ahead.
Co-Chair Agbaje, Co-Chair Davids, and members. For the record, my name is Jordan Peoples, and I'm with the Legislative Budget Office. I'm here today with my colleague Vlad Florimon, who will later review the background of these tax credits, along with some analysis of the credits. We will present an overview of the tax expenditure evaluation for the tax credits for small breweries, small wineries, and micro distilleries. The beverages that are being produced by these manufacturers are all taxed under the alcoholic beverage excise tax. To clarify, these are three separate tax expenditures, but they are being bundled into one evaluation for efficiency and research, since they all share the same expenditure objective. We'll begin the presentation by going over the shared objective of the three tax expenditures. We will then provide some brief background information and review some evaluation findings that are not included in the statutorily required components of review. To finish the presentation, we will then walk through all 9 of the statutorily required components of review. As stated, all 3 of these tax expenditures share the same objective statement. The objective of these tax credits is to promote development and survivorship for small breweries, small wineries, and micro distilleries. The objective of these tax expenditures was approved by the Tax Expenditure Review Commission on March 15th, 2024, for the purposes of evaluating. The objective of these tax expenditures was presented under an initial review to the Commission. These initial reviews can be viewed in today's agenda as a part of the background materials. With that being said, I will now pass it over to my colleague, Mr. Florimond, so he can review the background of these tax expenditures along with some analysis from the evaluation.
Co-Chair Agbaje, Co-Chair Davids, and members. For the record, my name is Vlad Florimon, and I'm an economist with the LBO. As my colleague Jordan just noted, I will provide a brief overview of the 3 tax credits, and then I will present the main findings of the evaluation. First, the small brewers credit, the biggest of the 3 tax credits, both in terms of the number of recipients and the total amount of foregone revenues, was enacted in 1985 and is available to both in-state and out-of-state alcohol producers. With respect to out-of-state producers, an example would be a brewer that produced in Wisconsin or Iowa, but sold in Minnesota. So the credit would be based on the Minnesota sales. Put another way, the credit is based on beverages that are imported, directly or indirectly sold or possessed in Minnesota. The credit amount is $4.60 per barrel up to 25,000 barrels sold in a fiscal year. To claim the credit, a brewer must file the annual beer production report Form LB 42 with their excise tax return for brewers. As of September 25th of this year, there were 229 breweries in Minnesota. Next, the small winery credit was enacted in 2017 and is available to both in-state and out-of-state alcohol producers who produced fewer than 75,000 barrels of product annually. Qualifying wineries can claim up to $136,275 on the excise tax that they owe on wine or cider sales the following fiscal year. The credit is based on wine manufactured, imported, sold, or possessed in Minnesota. To claim the credit, a winery must file the small winery production report Form LB 56P with their farm winery tax return Form LB 56F by January 18th for the previous year's claiming. As of September 25th of this year, there were 121 wineries in Minnesota. And then finally, the micro distillery credit was enacted in 2014, and contrary to the 2 previous tax credit mentions in the 2 previous slides, this tax credit is available only to in-state distillers that produce fewer than 40,000 proof. The credit amount is $1.33 per liter on 100,000 liters sold to consumers at a retail in a fiscal year. To claim the credit, the distillery must report the number of proof, gallons produced, during the calendar year as part of their December microdistillery excise tax return. As of September 25th of this year, there were 49 distilleries in Minnesota. Next, so before we turn to the findings of the evaluation, so we are going to take a look at the latest claimant data. We should emphasize that these numbers are claims, not necessarily the number of micro distilleries or brewers or small wineries in Minnesota. So to that end, there were on average 285 small brewers that claimed the credit for an average claim amount of $6,500, which gives a total amount of about $1.8 million. On average, 79 small wineries claim the credit for an average amount of $1,500, and this gives a total amount of about $120,000. And finally, over the same period of time, 39 micro distilleries claim the credit for an average claim of about $8,100, which gives a total amount of about $322,000. So one important factor that's not on that screen, but is important to highlight, is that some of the tax credits go to out-of-state alcohol producers. For example, in the case of small brewers, so 15% of the $1.8 million go to out-of-state alcohol producers. Next, we are going to present the findings of the evaluation. So to evaluate the effectiveness of the two tax credits, we used three main approaches at the LBO. So first, we conducted a survey of small alcohol producers in Minnesota. Second, we analyzed three sets of data. So we analyzed data from the Minnesota Department of Public Safety. We analyzed data from the U.S. Bureau of Labor Statistics, and then we also analyzed licensing data from other states. So to preview the overall findings of the evaluation, looking at the weight of the collective evidence based on the three approaches that we used, it seems that the three tax credits do help small alcohol producers, but the extent to which that they do so remains undetermined. Now I'm going to go over the three approaches that we used and highlight their findings. First, from the survey, about 78% of respondents described the credit impact as very positive, 21% described it as positive, and just 2% of respondents said that the credits had no impact on their business. Also, survey responses suggest the credits positively impact both growth and the ability to stay in operation. When asked to describe the tax credits impact on output growth, 45% of descriptions focus on the ability to stay in operation, 34% discuss business growth, and only 2% of respondents reported that the credit had no effect. Many respondents credit the tax credits for positively impacting their business to remain competitive in an increasingly difficult marketplace. Overall, the respondents describe the credit as a great support in helping their business to survive. Next, we analyzed three different sets of data. So we analyzed data from DPS, which is the Minnesota Department of Public Safety, from 2001 to 2025. We analyzed data from the BLS, Bureau of Labor Statistics, from 2017 to 2024. And we analyzed licensing data from different states. So three trends emerged from those three sets of data. So one is that the small alcohol producers in Minnesota, they tend to stay in business for an average of 7.8 years. And to put the Minnesota numbers in perspective, we reached out to 47 states to collect licensing data, and we did get a response from 9 states. So the average survivorship rate of 5 comparable states was 5.8 years. So that's smaller than Minnesota's 7.8 years. So the comparable states that we analyzed were Connecticut, Missouri, New Hampshire, North Dakota, and Pennsylvania. So Minnesota has the second highest survivorship rate among the states that we analyzed. Next, to see whether this is something that's unique to alcohol producers in Minnesota, so we reach out to, we analyze data from the Bureau of Labor Statistics, and we conclude that all new Minnesota businesses, they survive at a rate of 45.7% compared to 43.2% of new businesses in the US. So we conclude from this analysis that alcohol producers in Minnesota tend to outlive alcohol producers in other states. And then we also conclude that Minnesota businesses tend to do better than businesses in other states. Therefore, we cannot attribute the relative longevity of Minnesota alcohol producers to the 3 tax credits. And finally, we conducted an economic impact analysis using a software called M-Plan, which is a widely used input and output software in tax expenditure evaluation. In doing so, we wanted to understand the magnitude of the impact of the tax credits on the Minnesota economy. To that end, we look at 2 different scenarios. So the first scenario, we ask the following question. So in 2025, the state gives $2.3 million worth of tax credits to small alcohol producers in Minnesota. So we ask, what does that generate in terms of economic impact? So from our analysis, so on average, the $2.3 million in tax credit generated in 2025, about 14 jobs and a total economic output of $1.7 million. Next, as an alternative, so in scenario 2, we ask, what if Minnesota were to repeal the 3 tax credits and use the foreign revenue to increase government spending? So we assume that the money would be distributed to budget categories based on the share of each category in the Minnesota budget. From this exercise, the model suggests that the state would gain about 23 jobs with a total economic output of $2.5 million. The findings of our economic impact analysis is in line with a similar study that was conducted in the state of Washington, analyzing a similar tax credit. And then they found that the tax credit led to a gain of 2 to 6 jobs in scenario 1 and a gain of 25 to 27 jobs in scenario 2. So these numbers are not meant to be precise effect of the tax credits on the Minnesota economy. Rather, they are meant to convey the possible magnitude of the impact of the tax credits on the Minnesota economy. So to conclude, we cannot say from a cause and effect perspective how many small alcohol producers that would have gone out of business in the absence of the tax credit. But based on the survey evidence, it seems that the tax credits have helped some small businesses. So if there are no questions at this time, I will turn to my colleague Jordan to review the 9 components.
Sorry, one question. You talked about how the economic impact of the tax credits in 2025 gained 14 jobs, but then if it was repealed, the analysis was showing it would gain 23 jobs. So I was just wondering where the extra jobs come from if we were to repeal those tax credits and why it's showing up that way.
Yeah, so thank you, Madam Chair. So yeah, so for that, we look at 2 different scenarios. So the software that we use doesn't give us the precise sectors, for example, in which that the jobs would come from. It's just the overall number of jobs that would be created.
So, okay, so the analysis system just is showing that somehow with, I guess, the additional collection of that money, that more jobs would somehow be created,
Yes.
but there's no other precise data on it. Or Director Larson.
Madam Chair and members, so this type of modeling assumes that, so in scenario 1, the assumption is you're taking the additional revenue that was not paid to the state and putting that back into the small alcohol producing industry. And it's going to work its way through the economy and create an additional 14 jobs, whether it be strictly in the economy or kind of supporting industries that's in around that, and then kind of induced jobs, which would be, someone goes and spends their money at the grocery store and good. So of all of that, it assumes about 14 new jobs are created. In the scenario two, and how this analysis is generally handled in these type of evaluations, is you say, okay, we're going to take that foregone revenue that went to the state and put that back into the state. And then it assumes that the industries impacted are those that are around kind of how the state currently spends government spending. And then generally you'll see results like this in this type of analysis, in the sense that government tends to make jobs out of the dollar spent. That a lot of times, like government is a jobs heavier industry. And so therefore you'll see things like jobs being higher when you make some government spending as opposed to some other industries. That's not a blanket statement across all industries in this type of analysis. In this case, that's kind of what that's showing, if that makes sense.
Thank you, Director Larson. Representative Robbins.
Thank you, Madam Chair, and thank you to our testifiers. So my quick math on this is that the total cost of this credit was 2.224 million, but it says that economic impact was 1.7 million. So that rounds out of the 14 jobs to $158,893 per job. So I just think we need to be thinking about that impact. We're spending more than we are gaining in the impact by your analysis, as far as I can tell. And secondly, I appreciate the two scenarios in the economic impact, but I think there should be a third one I would like to see analyzed, which is what if the money was returned to taxpayers? What would be the impact of that? Because I don't think the only two choices are always give it to the particular credit or give it back to the state. There should be, what if we give it to the taxpayers, and how does that impact the economy? So I think going forward, if we could have that third metric looked at, I think that would be a helpful analysis for us. Thank you.
Senator Weber.
Thank you. One of the things I noticed, I think there was 280 some different claimants for the credit in the early part of your report. From what I understand in visiting with people close to the industry, there are a number of microbreweries that have actually went out of business. And do we know, have we had a net loss of these type of businesses in the last few years in Minnesota?
Mr. Peoples or Mr. Flourman?
So chairs and members, so that's a question that we can get back to you in terms of a net loss. Yeah, so that's it. We can analyze the data further to see if there has been a net loss in the last few years.
Thank you, Ms. Flourman. Any other questions? Representative Robbins.
Sorry, I had just one more question that I think would be helpful in all of these analyses for us. So how many other states have the credit? I know you mentioned like 5 you compared us to, or is that the only other 5 that have this credit? And then how does our credit amount compare to other states? Because I think one of the things we're always looking at is how we can improve Minnesota competitiveness. So understanding, how many other of the 50 states have the credit and what the amount difference is in any analysis that we're reviewing, I think would be super helpful. Thank you.
Thank you, Representative Robbins. I think that you may probably find some of that information on page 19 of the full report, cumulative fiscal impacts of other states and federal taxes.
Thank you.
Let me know if that's correct. Okay, well, with that, we'll move on to the rest of the presentation. We also have 2 more reports, so I just want to make sure that we are cognizant of the time. So, thank you. Mr. Peoples or Mr. Flourman?
All right, for the remainder of the presentation, I'll provide an overview of our evaluation's findings with respect to the first 8 components of review as required under Minnesota statute, section 3.8855, subdivision 5. This first slide covers the estimates of fiscal impact, which are taken from the 2024 tax expenditure budget, which is published by DOR Tax Research Division. As you can see, the credit for small brewers has the largest estimate of foregone revenue year after year, followed by the credit for micro distilleries, then followed by the credit for small wineries. The second required component of review is the objective of the tax expenditures. As stated previously, the objective of the small brewery, small winery, and micro distillery tax credits is to promote the development and survivorship of small breweries, micro distilleries, and small wineries. This objective was approved and adopted by the Tax Expenditure Review Commission on March 15th, 2024, for the purposes of evaluation. The third component of review is discussing the impacts and efficiency that these tax credits have in accomplishing their objective. Through the survey that was administered and by evaluating business survival rates from DPS licensee data, the LBO determined that these tax credits likely contribute to the development and survivorship of these specific industries, but the extent of the contribution is not definite. Almost all of the survey respondents indicated that the tax credits had a very positive or positive impact on their business's growth due to the very small margins that these businesses typically work within. The evaluation also brought to light that small alcohol producers in Minnesota tend to outsurvive small alcohol producers from other states. With that being said, it's unclear whether this is due to the influence of the tax credits or if it's due to other elements of the Minnesota market. The fourth required component of review is a comparison to a direct expenditure with the same objective. With that being said, the LBO, we did not identify any direct spending programs with the same policy objectives as these tax credits, so the conversation is more theoretical. There are both benefits to administering this program as a tax expenditure and as a direct spending program. The benefit of having these tax credits as a tax expenditure is that it allows any eligible alcohol producer to benefit, whereas direct spending programs generally are capped, limiting the number of recipients. Reaching this policy objective can also be reached through direct spending programs. One benefit of administering this program through a direct spending program is that it reduces the barrier of entry for participants. Currently, only small alcohol producers that produce a product can benefit because the credit amounts are production-based. Having the program as a direct spending program could help assist aspiring small alcohol producers, not just the ones already in business. Another positive of reaching this policy objective through a direct spending program is that the legislature can more precisely target intended behavior. As a tax expenditure, the money businesses receive can be used however the owner wants to use it, whereas a direct expenditure can have more rules attached dictating how the money can be used. Our fifth component requires these evaluations to identify potential modifications that would make these policies more efficient or effective. The LBO has come up with 3 different ideas to do so. The first being to issue the tax credits based on other characteristics outside of production amounts. This could be things such as jobs or capital equipment investments. The second recommendation addresses the administrative burden from the perspective of the businesses. The recommendation would be to require quarterly production amount filings instead of monthly amount filings. This would be 1/3 of the work for businesses compared to the current administration of the tax credits. From the perspective of the Department of Revenue, the Special Taxes Division voiced that these tax credits are generally not too administratively burdensome outside of some timing issues attached to the credits being tied to calendar year production, but the credit is taken on a fiscal year basis, causing some occasional errors by taxpayers. The third recommendation would be to increase the overall awareness of these tax credits to eligible producers. Statute also requires these evaluations to produce a revenue-neutral tax rate reduction. The Department of Revenue completed these calculations and published them in the 2024 tax expenditure budget. On this slide, the middle column displays the current per liter and per 31-gallon tax rate for different types of products that are produced by small breweries, micro distilleries, and small wineries. The column on the right then shows what the per liter and per 31-gallon tax rate would be if these tax expenditures were repealed and the tax rate was reduced but applied to a larger base. Statute also requires an analysis of the incidence of the tax expenditures and their impact on the state tax system. If, that is, if a tax expenditure is considered to be a significant tax expenditure. With that being said, these three credits are not deemed to be significant tax expenditures, so there's no incident study for these three credits. The last required component is an analysis of the cumulative impacts of federal and state policies aimed at addressing similar activity. At the state level, the LBO identified two different expenditures that work towards the same policy objective as to these credits. First being the Minnesota Capital Equipment Tax Exemption, which had an estimated $1.9 million in received benefits for small alcohol producers in fiscal year 25, along with the Minnesota Research and Development Tax Credit. On the Minnesota Research and Development Tax Credit, there was no public information regarding how much small alcohol producers in the state benefited from this expenditure. At the federal level, the LBO identified the federal tax credit for increasing research activities. Similar to the Minnesota Research and Development Tax Credit, it was unclear how much Minnesota small alcohol producers benefited from this federal tax credit. The last component of review is a recommendation to the legislature to continue, repeal, or modify this policy. With that in mind, we're happy to provide more information to the content presented today or the material within the report to inform a decision by the commission. For the sake of time, we're not covering the appendix slides during this presentation, but they have been made available for your reference. We are happy to provide any discussion or follow-up from members. Thank you.
Thank you, Mr. Peoples and Mr. Flourmont, for your presentation. I will open the floor if there's any questions from commission members, as this will be one of the ones that you will fill out your first form for. So, Commissioner Marquardt.
Madam Chair, that was my question, is that as we start the process now, this would be the first one that immediately we will get one of these forms to evaluate this. And then, you know, under number 5, where there was modifications for efficiencies and that could go under modify, and then you'd put that, you know, if you wanted, so it's just changing some things in there that would, all right, I think we're.
Yes, that is correct.
All good.
Yeah. So, so hopefully folks will take a look at this. I think these are kind of some, hopefully, low stakes one. I'm sure I will now receive many emails from the industry saying it's not low stakes, but for at least the commission, hopefully these are some low stakes ones that you can kind of dig in a little bit to get a sense of how you want to be filling out that form, and help our conversation when we do decide on the next steps for the recommendations to the legislature. So with that, we'll move on to the lawful gambling tax expenditures evaluation report. And we have that report presented to us by LBO staff Annie Lemieux and Thomas Rainey, and I will turn it over to the both of them to begin their presentation. As you get set up, and then once you're ready to start, please state your name and title for the record, and then you may begin.
Co-Chair Agbaje, Co-Chair Davids, and members, for the record, my name is Thomas Rainey. I'm a program evaluator at the LBO. While we're getting set up here, I'd just like to note that the evaluation materials, including the evaluation itself, the summary report, as well as the slides, are in your packet for reference. Co-Chair Agbaje, Co-Chair Davids, and members, again, for the record, my name is Thomas Rainey. I'm a program evaluator with the LBO. I will be providing you with background information on the lawful gambling tax expenditure evaluation. I will cover the objectives of the tax expenditures included in this evaluation, background information on each tax expenditure, and my colleague, Ms. Lemieux, will go over each of the first 8 components of review. This evaluation includes a total of 6 tax expenditures. There are 4 exclusions, 1 exemption, and 1 credit. These are all of the tax expenditures listed in the lawful gambling taxes section of the tax expenditure budget. I will discuss each tax expenditure individually to begin, but the findings will be discussed together. I'd like to note the differences between excluded and exempt gambling activities. Excluded raffles do not require a permit or a license from the Gambling Control Board, whereas excluded bingo and all exempt activities requires the organization to obtain a permit from the Gambling Control Board, but they do not need a license. The only exemption in this evaluation is lawful gambling under certain conditions. Bingo at certain organizations, bingo at fairs and civic celebrations, infrequent bingo occasions, and smaller raffles are all exclusions. 5 of the 6 tax expenditures, bingo at certain organizations, bingo at fairs and civic celebrations, infrequent bingo occasions, smaller raffles, and lawful gambling under certain conditions, all share the same objective, which is to simplify compliance with and enforcement of lawful gambling and reduce administrative burden. The last tax expenditure, the credit for certain raffles, has the objective to direct a higher amount of net raffle proceeds used exclusively to relieve the effects of poverty, homelessness, or disability. These objectives were approved and adopted by the Tax Expenditure Review Commission on May 31st of 2024. I'll now go over each tax expenditure in this evaluation, starting with bingo at certain organizations. An exclusion from the lawful gambling tax is allowed for bingo conducted within a nursing home or a senior citizen housing project or by a senior citizen organization if certain conditions are met. The prizes for a single bingo game cannot exceed $10, and the total prizes awarded at a single bingo occasion cannot exceed $200. The estimated fiscal impact is less than $50,000 for fiscal year 2026. Bingo at fairs and civic celebrations. The lawful gambling tax is not imposed on bingo conducted by an organization in connection with a county fair, the state fair, or a civic celebration. To qualify, the bingo cannot be conducted for more than 12 consecutive days, and no more than 4 applications can be applied for and approved in a calendar year. The estimated fiscal impact is less than $50,000 for fiscal year 2026. Infrequent bingo occasions. An exclusion from the lawful gambling tax is allowed for bingo conducted by an organization which conducts bingo on 4 or fewer days in a calendar year. This exclusion does not apply if the organization holds a lawful gambling license. The estimated fiscal impact is $100,000 for fiscal year 2026. An exclusion is allowed for smaller raffles if the value of all raffle prizes awarded by an organization in a calendar year does not exceed $1,500. The exclusion also applies if the organization qualifies under Section 501c3 of the Internal Revenue Code and the value of all raffle prizes awarded at one event in a calendar year does not exceed $5,000. The estimated fiscal impact is $300,000 for fiscal year 2026. Next is the exemption for lawful gambling under certain conditions. All types of lawful gambling except linked bingo games are exempt from the lawful gambling taxes if certain conditions are met. To qualify, an organization must conduct lawful gambling on no more than 5 days in a calendar year and cannot award more than $50,000 for prizes in lawful gambling in a calendar year. The estimated fiscal impact is $2,900,000 for fiscal year 2026. Lastly, the credit for certain raffles. An organization may claim a credit against the lawful gambling tax equal to the tax resulting from a raffle if the net proceeds have been used exclusively to relieve the effects of poverty, homelessness, or mental or physical disability for an individual or family. 25 organizations claimed this credit in fiscal year 2023, and the estimated foregone revenue was less than $50,000 in fiscal year 2026. The LBO used several sources to evaluate these tax expenditures, including materials from nonpartisan legislative research, the Gambling Control Board annual report, and summary tax filing data for all of the tax expenditures included in this evaluation. A questionnaire was administered and an interview is conducted with the Gambling Control Board to get a better understanding of compliance and administrative burden. Based on that information, it is likely that all of the tax expenditures with the shared objective to simplify compliance and reduce administrative burden do meet that objective. The credit for certain raffle likely meets its stated objective based on the requirements to claim it. All net proceeds must be used exclusively to relieve the effects of poverty, homelessness, or physical or mental disability for an individual or family. Additional analysis is neither required nor feasible, either due to these expenditures being relatively small, their mechanics, or the simplicity of the objectives. If there are no questions at this time, then I'll now turn it over to Ms. Lemieux to discuss the findings of our evaluation with respect to the first 8 components of review.
Chair Bajaj, Chair Davids, and members, for the record, my name is Annie Lemieux. I'm a program evaluator with the Legislative Budget Office. As my colleague just noted, I'll provide an overview of our evaluation's findings with respect to the first 8 components of review as required under Minnesota Statute Section 3.8855, Subdivision 5. To begin, the first required component is an estimate of foregone revenue. The estimates on this slide are the same estimates provided by the Department of Revenue in the 2024 tax expenditure budget. Each line shows the estimate of annual foregone revenue for each tax expenditure included in this bundle by fiscal year. The second required component is an objective of the tax expenditure. My colleague already covered this item, so I will just reiterate that the Tax Expenditure Review Commission approved and adopted the objectives on this slide on May 31st, 2024 for the purposes of evaluating the lawful gambling tax expenditures as a bundle. The third required component includes understanding the tax expenditure's impacts and efficiency in accomplishing the approved objectives. The current lawful gambling tax expenditures were found to likely meet their established respective objectives. The 4 exclusions and 1 exemption shared the objective of simplifying compliance with and enforcement of lawful gambling and reducing administrative burden. Through discussion with the Gambling Control Board, an enforcement of the lawful gambling tax on these currently exempted and excluded activities would require voluntary reporting of participating organizations, which would increase administrative burden and decrease the simplification of compliance. The credit for certain raffles likely meets the objective of directing a higher amount of net raffle proceeds used exclusively to relieve the effects of poverty, homelessness, or disability that would occur but for the credit through utilization, as obtaining the credit requires organizations to have donated the proceeds from their gambling account directly to the targeted individual or family. The 4th required component of review is a comparison to a direct expenditure with the same objective. No other states have direct expenditures targeting any of the exempt or excluded populations for lawful gambling purposes. Minnesota does not have any direct payment programs targeting lawful gambling. There are numerous direct expenditure programs that are aimed at relieving the effects of poverty, homelessness, or disability. However, most programs are not hosted through lawful gambling activities. The only comparable type of direct payment program identified was the general concept of charity sweepstakes targeted to relieve the effects of poverty, homelessness, or disability. As charity sweepstakes generally can be sponsored by any entity, there is no available data on the frequency or funds raised in Minnesota through this method of proceed donation. Another requirement is to identify potential modifications that would make these policies more efficient or effective. No potential modifications to increase the tax expenditure's efficiency or effectiveness were identified. Statute also requires these evaluations to produce a revenue-neutral tax rate reduction. The Department of Revenue completed these calculations and published them in the 2024 tax expenditure budget. The evaluated exclusions and credit both have a negligible revenue-neutral rate. To offset the cost of the lawful gambling under certain conditions tax exemption, the lawful gambling tax could be reduced from 8.5% to 8.4%. The last required component is an analysis of, oops. Statute requires an analysis of the incidence of the tax expenditure and its impact on the state tax system if a tax expenditure is considered to be a significant tax expenditure. None of the tax expenditures included in this evaluation are considered to be significant tax expenditures as defined by the Department of Revenue Tax Research, and therefore are excluded from the requirement for an incidence study as a part of a tax expenditure evaluation. The last required component is an analysis of cumulative impacts of federal and state policies aimed to address a similar activity. For the evaluated exclusions and exemptions, research was conducted for programs that simplify compliance with and enforcement of lawful gambling and reduce administrative burden, but no other unique programs were identified. Continuing to an analysis of cumulative impacts of federal and state policies for the credit for certain raffles, there are a few relevant policies worth mentioning. At the federal level, an exempt organization may deduct from its unrelated business taxable income the contributions and expenditures made from gaming proceeds as ordinary and necessary business expenses under Internal Revenue Code Section 162 if the organization was required to donate these proceeds to charity in order to retain its gaming license. The federal government imposes an excise tax on state-authorized and unauthorized wagers at a rate of 0.25% and 2% respectively. Several exemptions and one credit are also available for different wagering activities. Pari-mutuel wagering, coin-operated devices, and state-conducted lotteries are all exempt from the federal excise tax. A credit is allowed if a person overpays the tax imposed under U.S. Code Section 4401, imposition of tax on wagers. In Minnesota, exempt qualifying 501c3 and 501c4 festival organizations may deduct gambling fund transfers on their unrelated business income tax return following specific guidelines. The last component of review is a recommendation to the legislature to continue, repeal, or modify the policy. With that in mind, we're happy to provide more information to the content presented today or the material within the report to inform a decision by the commission. I will mention that the slide deck does contain appendix slides. We encourage members to reach out on any of that material if more follow-up would be helpful. Thank you.
Thank you, Ms. Lemieux and Mr. Rainey. I'll open the floor to any questions from commission members. Doesn't look like anyone is online. I'll just also reiterate if I hadn't made it clear before. So as we'll be getting the evaluation forms to fill out, we'll be filling them out for each expenditure, since I think we'll have to give a recommendation on each expenditure. So as we're going through these, the ones that we're hearing now, we heard 3 that were related to the wineries and distilleries and breweries. So you'll have 3 for those. There's 6 here. So you'll have 6 for these ones related to gambling. And then I think our next set, I don't know how many are in there, but that'll be another set. So because we're presenting them all together because they all deal with the same topic, so hopefully it'll help make the evaluation run a little bit smoother. But you know, if there's one that really stands out to you for one way or the other, you can use your forms to indicate that. With that, we'll move on to our last set of presentations on the residential heating, fuels, residential water services, and sewer services tax expenditures by Carlos Huerta and Jordan Peoples. And once you guys are set up, you know the drill. Please state your name and title for the record and then begin.
All right, Co-Chair Agbaje, Co-Chair Davids, and members. Once again, for the record, my name is Jordan Peoples, and I'm with the Legislative Budget Office. I'm here today with my colleague Carlos Guerica, and we will present an overview of the evaluation of the sales and use tax exemptions for heating fuels and utility services. To clarify, these are three separate tax expenditures, but they are being bundled into one evaluation for efficiency and research, since they all share the same tax expenditure objective. Heating fuels and utility service exemptions include residential heating fuels, which are tax exempt from November through April, residential water services, and sewer services. We will begin the presentation by going over the shared objective of the three tax expenditures. We will then provide some brief background information and review some evaluation findings that are not included in the statutorily required components of review. To finish the presentation, we will then walk through all 9 of the statutorily required components of review. As stated, all 3 of these tax expenditures share the same objective statement. The objective of the heating, fuel, and utility service tax exemptions is to lessen the effective tax burden of lower income households and to reduce the regressivity of the sales and use tax. The objective of these tax expenditures was approved by the Tax Expenditure Review Commission on August 16th, 2024, for the purposes of evaluating the sales and use tax exemptions for residential heating fuels, residential water services, and sewer services. The objective of these tax expenditures was presented under an initial review to the Commission. These initial reviews can be viewed in today's agenda as a part of the background material. All right, so getting into the background here. So residential heating fuels, residential water services, and sewer services are all exempt from the sales and use tax. The exemption for heating fuels was enacted in 1978 and was expanded to include hot water as well in 1984. The exemption for water services was enacted in 1979, and sewer services have actually never been subject to the sales and use tax. These tax exemptions apply to all Minnesota households regardless of consumption volume, location, household income, or any other qualifying characteristic. In fiscal year 2026, among all 3 of these tax expenditures, the DOR Tax Research Division estimates that there will be roughly $344 million in foregone revenue due to these 3 tax expenditures combined. This slide displays the magnitude of the 3 sales and use tax exemptions by highlighting their estimates of foregone revenue from fiscal years 24 through fiscal year 27. As displayed, the foregone revenue estimates for all 3 expenditures rise year after year due to numerous factors such as population growth and utility price increases. The tax exemption for residential heating fuels accounts for roughly 58% of the cumulative foregone revenue. Sewer services account for roughly 34%, and residential water services account for roughly 8% of the cumulative foregone revenue. So getting into some findings here, by mere existence, all 3 of these tax expenditures do reduce the regressivity of the sales and use tax in Minnesota. The DOR Tax Research Division published the 2024 Tax Incident Study, which highlights how Minnesota's tax structure impacts households and businesses in the state. The incident study provides a suits index for a sample of state and local sales taxes together, indicating whether the category is regressive or progressive. The suits index is a numerical range from -1 to +1, with 0 representing a proportional tax. A progressive tax has a positive index number, and a regressive tax has a negative index number. The 2024 incident study indicates that the suits index for state and local sales tax is -0.221, indicating that sales and use taxes tend to be regressive. If any of these expenditures were repealed, the suits index for state and local sales and use tax would get more regressive. If all 3 of these expenditures were repealed at the same time, the suits index for state and local sales and use tax would be -0.234. On this next slide here, this table displays the change in tax burden for each population decile. The state of Minnesota is broken down into 10 different population deciles. Each decile contains roughly 293,000 households. These deciles are grouped from the lowest income earning households in the state to the highest earning households in the state. The higher the decile, the more income a household makes. If these tax expenditures were to be repealed, there would be an increase in tax burden for all households. The change in tax burden would be the largest for low-income deciles and gradually declines as household income increases. To evaluate how different households benefited from these tax exemptions, the LBO looked at different population deciles and their average annual savings due to these exemptions. Now, across all population deciles in 2024, Minnesota households had roughly $109 in tax savings cumulatively due to these three tax exemptions. The first through the sixth population deciles all fell below this average amount of tax savings. As displayed, there is a gradual increase in the average tax savings a household receives as a household income increases, with there being a sharper increase from the 9th to 10th decile. By existence, any Minnesota household that purchased these utility services receives some monetary tax savings as a product of these tax exemptions. With that being said, different population deciles had different monetary benefits from these exemptions. Higher income households receive more tax savings from these tax exemptions than lower income households, as well as a larger percentage change in tax share. The first through third population deciles, which represents households with an income below roughly $35,000, received on average roughly $72 in tax savings due to these expenditures. On the other hand, the 8th through 10th population deciles, so households that make roughly over $95,000 annually, received on average $165 in tax savings due to these expenditures. While higher earning population decile households receive more monetary benefits from these tax exemptions, lower income deciles receive a reduction in their tax burden that is marginally higher than that of higher earning deciles. Now, with that being said, if there are no questions at this time, I'll now pass it over to Mr. Guedica to review the 9 statutorily required components of review.
Okay. Chair Bajay and members, again, for the record, my name is Carlos Whitaker, budget analyst with the Legislative Budget Office. So I'll just go through the 8 components of review. The first component is the estimate of annual revenue loss. And so the table on slide 11 represents the same estimates reported in the 2024 tax expenditure budget. So in fiscal year 2026, the estimated foregone revenue for the residential heating fuels tax exemption is $199 million. For residential water services, it's roughly $29 million. And for sewer services, it's just over $116 million. The second component of review is an objective of the tax expenditure. My colleague, Mr. Peoples, already covered that in detail. So I'll just mention that the Tax Expenditure Review Commission did approve that statement in August of 2024. Component of review number 3 calls for an assessment of impacts and efficiency in accomplishing the objective. So the 3 tax exemptions result in an impact to over 2.3 million households with an average benefit of $109 per year. There's no limit to the benefit a household can receive other than how much of the good or service that they consume in certain months of the year. So in this case, the goods or services are quite targeted. There's essentially no administrative burden to the beneficiary. There's no need to opt in. There's no need to follow up to re-verify eligibility. It's quite straightforward. So to summarize here, there's a large statewide beneficiary pool with a relatively small annual household benefit, and there's no cap on the program. And so component of review number 4 asks that the tax expenditures be compared to a direct payment program with a similar aim or same objective. So several direct payment programs are identified within the report. For the sake of this presentation, we'll compare the impact and design to the cash assistance portion of the Minnesota Family Investment Program. So families can use the cash assistance benefit to help pay for their basic needs like shelter and utilities. The comparison between these tax expenditures and the direct payment program is limited to policy design considerations and just some high-level statistics. So the cash assistance program is funded through the Federal Temporary Assistance for Needy Families Block Grant and state appropriations.
So the program is limited by available funding. Eligibility is income dependent, and households must meet certain work requirements to participate. Additionally, there are certain requirements to who's eligible for specific benefits under specific sources of funding. The average cash assistance payment in September of 2025 was $545, and 21,276 families participated in the cash assistance program. So as I mentioned, participation can be contingent on several design elements like income thresholds, job requirements, available funding, and participants opting in. So we find that these elements do tend to result in smaller beneficiary pools with a higher benefit in this case. So there are merits in program design to consider for both options. For the purposes of this evaluation, this comparison is relatively high level. Component overview number 5 asks that potential modifications be identified to increase efficiency or effectiveness. One potential modification to consider is a limit to the amount of each utility that is tax exempt. So based on the objective approved by the Tax Expenditure Review Commission, if the focus of the tax exemption is meant to be on providing tax relief to low-income households, then a limit on consumption based on a metered threshold may be beneficial in limiting the benefit to a targeted group. So under the current design, each tax exemption, higher income households receive a larger monetary benefit, as we described, with no limits. So you can consider, for example, the state of Maine, which exempts electricity used for residential use up to 750 kilowatt hours per month. A limit to these exemptions based on an average household consumption of each service may be a reasonable alternative to focus the benefit of these tax exemptions to low-income households to align with the objective of these tax expenditures. For reference, in 2024, the average monthly consumption of electricity for residential use was 712 kilowatt hours. Okay, the 6th component of review is a calculation of the revenue neutral rate. If any of these tax expenditures were independently repealed, they could be matched with a reduced tax rate to achieve the same levels of tax revenue to the state. So repeal of the exemption on residential fuels could result in a 0.145 percentage point reduction in the sales and use tax. Similarly, repeal of the exemption on residential water could result in a 0.025 percentage point reduction the sales and use tax rate, and then repeal of the sewer services exemption could result in a 0.085 percentage point reduction. Moving on to component review number 7. So this requires an analysis of the tax expenditures incidence and impact on the incidence of the state tax system. So the table on slide 18 illustrates the cumulative tax change and share of tax change relative to each population decile. It's calculated by the tax research division at the Department of Revenue. So 55% of the tax change resides in the top 4 highest earning population deciles, so deciles 7 through 10, or households making over $73,699. So 55% of the tax change equals roughly $176 million out of $318.4 million in total tax change. The remaining 45% or 142.5 goes to the first 6 deciles. So this table further indicates that the share of tax change increases incrementally by population deciles as income increases. Again, it's worth noting that each population decile contains about 293,739 households based on kind of how the sample is produced. So to summarize this slide, and on incidence, higher income households receive more monetary benefit than lower income households, and a larger percentage of the change in tax share. In terms of impacts to the state system, we'll just go on to this next slide. And so we'll kind of touch on regressivity again. So in terms of impacts to the state tax system, the 3 tax expenditures do reduce the regressivity of the sales and use tax. Again, this was determined based on a calculation of the suits index. And so, again, just to reiterate what my colleague mentioned, if these were repealed, if these tax expenditures were repealed, This would result in a reduction of the suits index from negative 0.221 to to negative 0.232. Again, these tax expenditures do lower the tax burden for each population decile, but marginally more so for lower income deciles as a proportion of their income. All right. Here, the last slide, or I'm sorry, the last component here that we'll cover in detail is component overview number 8. So a cumulative impact assessment of other state and federal programs aimed at addressing a similar activity. Several programs are identified, 3 that are at the federally funded and are administered at the state or local level. These are the Energy Assistance Program, the Weatherization Assistance Program, and the Low Income Households Water Assistance Program. Also identified was the MFIT program, or the Minnesota Family Investment Program, which I described already and depends on a combination of state and federal funds. There are state laws that protect Minnesotans from service shutoff in extreme weather conditions. And then lastly, there are privately administered assistance programs through utility providers. Those programs we didn't include in the cumulative impact estimates. So just to highlight the cumulative fiscal impacts here, I'll mention that there's a limitation in the availability of data across the same time frame. So the figures provided on this slide, on slide 20 here, are the most recently published program cost estimates that we found specific to Minnesota. Unfortunately, they do not necessarily overlap. In fiscal year 2022, there were $22 million in low-income household weather assistance program and weatherization assistance program funds. In fiscal year 23, there were over $313 million in federal and state funds directed to the Minnesota Family Investment Program. Let's see here. And I'll just mention that families can choose to opt out of the cash assistance program. And so some of the figures that you see here may be some combination of benefit of different services like food assistance, childcare assistance, or combination of these. Some of these households may not receive cash assistance. And then finally, there were $95.9 million in energy assistance program, $95.9 million in energy assistance program dollars in federal fiscal year 2024. Okay, so as you're well aware now, the component 9 is a recommendation to the legislature. And so we'll kind of leave our presentation there, and we're happy to answer any questions that folks have.
Thank you, Mr. Werka and Mr. People. One question, I just wanted a clarification. When you pointed out in the modifications piece, the state of Maine exempts up to 750 kilowatt hours. Did you also say what the average or the median kilowatt hours used in Minnesota was?
Madam Chair, members, I believe that I mentioned the average.
Okay, and that was 712 kilowatt hours.
Correct.
Okay. Might be nice to have the median too, just to kind of actually see how it's going across. And I don't know if there's also a way to try to figure out like what maybe geographic areas of the state are using more energy at different times, or if that corresponds to also income level too. I'm not sure, but any other questions or comments from members? Okay. Well, thank you everyone from LBO staff for your wonderful presentations, very detailed. I think it will help us a lot as we go through our evaluations. So again, we will be receiving evaluations from the LBO staff. We will have 1 week to fill them out. This will kind of be a big number of sheets, but hopefully with 3 issue areas, it should be helpful to kind of match them up together. We will come back with a schedule for the evaluations we've heard before. So I'll be in touch with LBO staff about how we can put that schedule together for the ones that we've heard already. I don't think I have any other directions to the LBO staff. Representative Davids, do you have anything else you'd like to share?
No, I think it was a good meeting today, and I'm looking forward to filling out the evaluations. When might we get those? I missed that.
Director Larson, do you know about when we may start receiving them?
Madam Chair and Chair Davids, our plan is to send them out either by the end of today or sometime tomorrow.
Okay, great. So sometime next Wednesday or Thursday is when they will be due back to LBO staff.
Great. Thank you.
Yes, go ahead.
No, thank you. Thank you, Chair.
Great. So then agenda items for the next meeting, we have 2 more meetings on the schedule for January before the regular session starts, and also before the TERC annual report is due on February 15th of 2026. So the first meeting in January is Thursday, January 15, 12 to 1:30. And at that meeting, the LBO will share compiled results of the at least these 3 previous tax expenditure evaluations. I think we'll talk about when we want to do the other 2 that we've heard. And then I'll just also note, so yeah, that's the big note for today. So basically you'll have multiple sheets for each of the tax expenditures that we've heard so far. Then at that next meeting, January 15, we'll have a discussion on the aggregated report that we received from the LBO. And then we'll have a vote on those, each of those tax expenditures to decide if we want to continue it as is, repeal it, or modify it in a manner that will be discussed at that meeting. The TERC then will also hear, once we go through those evaluations, we'll then also hear the tax expenditure evaluation report on the data center equipment tax expenditure, which was conducted for us by the University of Georgia, and they will also present it that day. The second meeting that we have in January is Wednesday, January 28th, 12 to 1:30. And at that meeting, we will review and approve the draft annual TERC report, which, as I stated earlier, is due on February 15, 2026. And then that meeting, hopefully too, will also vote on the data center tax expenditure that we would have heard at the previous meeting. And then in the meantime, check your emails and we'll try to catch up with the previous 2 that we heard, the wind and solar tax, and then I forget what the other one was, and the marriage tax credit. So very important items. And I'll see if there's any other. Okay. That being said, watch your emails. There'll be a lot of forms going. Some homework will be due, but I think this will help us keep on the right track to make sure that we are moving forward with the TERC. And anything else will be sent to you via email. So with that, we are adjourned.